So what is an SMSF? SMSF is short for self-managed super fund. What a SMSF is, you're going to create your own fund. So you're going to transfer all the super balance into your own fund where you can invest those funds yourself on however you like. Call it you want to invest in stocks, cash, bonds, ETFs, or even property, just to name a few. You have to make sure setting up an SMSF, that structure is the correct structure for you. That's why you have to talk to your accountant, your financial planner, to ensure that it is the right thing for you to do, especially when you haven't even invested before. Good day everyone, I'm your host Tony Xia and thanks for joining me on another episode of The Mortgage Chat. Today I'm going to give you a real case study on one of our clients that's purchasing something under an SMSF. So what is an SMSF? SMSF is short for self-managed super fund. So right now you probably have your super in an industry super fund, call it HESTA, Colonial First State, Australian Super, etc. Right? So what an SMSF is, you're going to create your own fund. So you're going to transfer all the super balance into your own fund where you can invest those funds yourself on however you like. Call it you want to invest in stocks, cash, bonds, ETFs, or even property, just to name a few. Okay, so what I'm going to do today is I'm going to show you how to borrow and leverage off an SMSF. So before I start on this case study, you have to make sure setting up an SMSF, that structure is the correct structure for you. That's why you have to talk to your accountant, your financial planner, to ensure that it is the right thing for you to do, especially when you haven't even invested before, such as investing in stocks or even property. Okay? And the reason why I say this is because the last thing you want to do is set up an SMSF when you haven't actually invested in stocks or investment before, right? So for example, the last 5-10 years, the average return on these super funds is around 10%. So if your super balance is 100,000, every 12 months you're getting a return of 10 grand for doing nothing, which is pretty good, right? So if you're setting up an SMSF and you're investing in stocks that's not growing, or you're buying a property that's not growing, so essentially you're actually going backwards. And the last thing you want to do is your super balance is going backwards rather than going forward, which is part of your retirement planning, right? So if you haven't invested anything before in your life, please just make sure you're investing in the right asset and make sure you have a good team around you. Call it, a mortgage broker, your buyer's agent, your financial planner, and your accountant. So guys, this case study is not financial advice. It's just showing you and giving you a guide of how an SMSF works and seeing if it's the right thing for you and it fits into your retirement planning. So everybody, on this case study, I have a couple. The first applicant was on $130,000. The second one's on $110,000. They're both receiving 11.5% employer contribution each. Now the first applicant is getting a contribution of $14,950. The second one is receiving $12,650. Now this balance is being deposited into their super balance on a regular basis, okay? So what is their borrowing power within an SMSF loan? So with a proposed rental income of $500 per week, with a rate of 7.5% at P&I repayments, their loan is around $490,000. So depending on which lender we go to, this may be higher or lower, but let's just use 490 as an example for now. And what you have to realize is majority of your major lenders don't offer SMSF loans anymore. And they've probably pulled out of the SMSF market back around 2015, 2016. And the only lenders that are pretty much offering SMSF loans are your smaller lenders or your second tier lenders or your online lenders, call it First Mac, Wealth, Think Tank, Blue Bay, Latrobe, Pepper, Resimac, and even Liberty. Okay, so if you go online right now and search for SMSF loans, you'll probably see that none of your major lenders like St. George, Westpac, CBA, Bank West, Macquarie Bank, NAB, ANZ, they don't offer it anymore because they've actually put out that market quite a fair while ago. So now let's get to the nitty-gritty bit. So what can these clients do with a borrowing power of $490,000 and also with a super balance of $200,000? Now, let's go to my computer right now. I'm going to do a Zoom demonstration. So if you're listening to this podcast, just please jump onto YouTube, have a look at this video because it will show you the breakdown of what we normally do for our SMSF clients in regards to the breakdown of the purchase price, the cash flow, and how fast they can pay down that SMSF loan by if they contributed a little bit more every month. So let's jump to the computer right now. Okay, everyone. So as you can see here on my Loom video, you'll see an Excel spreadsheet where it shows you the breakdown of the purchase price plus the cash flow of obtaining the loan, right? So essentially what I've done here is there's a super balance of 200,000, which as noted, right? So to buy something for 600,000, what is the breakdown and what is the total amount of money I need to use to obtain something for $600,000, right? So as you can see here, I used 162,000, and I'll tell you why I needed a minimum of 162,000 in a second. Okay, so they're buying something in Melbourne. Melbourne stamp duty for 600 grand is just under $33,000, which is quite hefty compared to all the other states. Okay, now obviously there's going to be solicitor costs, there's going to be legal sign-off costs, there's going to be changeover costs, there's going to be setup costs. Now, what I mean by this setup cost is setting up your SMSF, right? So you have to set up your SMSF, you have to set up your trustee, and you have to set up your bare trust, and your bare trustee will cost around $4,000 to $4,500. Some accountants might cost a little bit more or less, we don't know, but we're just using this as an example, okay? Bank fees could be higher, could be lower, depending on which bank we go to. Valuation, it could be higher, it could be lower, it could be for free, we don't know, so we're just going to use this as an example. So as a total cost to buy something for 600,000 at Melbourne, it's going to cost you $41,565. So essentially you have $120,435 left over for the deposit. Now, as you can see here, the remaining money as a deposit covers the 20% deposit to buy something for $600,000. Therefore, that's why the end loan is just under $480,000 with an LVR of just under 80%. So you don't have to pay lender's mortgage insurance now. Now, not a lot of lenders within the SMSF world does lender's mortgage insurance anyway. So we try to keep it as below 80% anyway. So as you can see here, I've got liquidity needed. So what does that mean is some lenders require you to hold a certain percentage of liquid assets, call it cash, stocks, or bonds within your SMSF based on a percentage of the loan amount. So what I have here is some lenders in this particular lender, they want you to have 5% as a liquid asset of the loan amount. So that's why it's just under $24,000 that you have to keep in stocks, cash, bonds, whatever you want to call it. Okay, something liquid. Okay, now, so you can see here, there's an extra $14,000 down here. Okay, so what does this $14,000 mean? It means just extra cash, right? So you can essentially use that extra cash for a bigger deposit in dropping that loan amount down, or you can invest that money in stocks, bonds, ETFs, whatever you want to do. All right. So essentially, to buy something for 600 grand, you need a minimum deposit of around $162,000, right? So a lot of people believes that, you need a bigger deposit for an SMSF loan, 30, 40%, which is not the case. Okay. You need 20% deposit plus stamp duty and plus at least some remaining for liquid assets. Okay. Some banks or some lenders require you to have a bigger super balance, but most these days don't have a requirement. Okay, so that is the breakdown of purchasing something for 600,000. Now let me show you cash flow of sustaining that loan. So you can see here, just under $480,000 right here as a loan, which connects to that down here, as you can see. All right, now what I've done here is I've used a rate of 7.74%. It could be lower, it could be higher down the track, but we'll just use 7.74 for now. Okay, at 30 years, P&I repayments, your repayments just going to be under $3,450. Okay, I've used rent of $500 per week. All right, now what I've got here is 30% expenses. Okay, so what I mean by that is, you have to pay expenses like property management fees, water rates, council rates, insurance, etc. So you're left with net of around $1,516. Okay, so your cash outlay to maintain that debt is just under $2,000. All right, now the good thing is you got excess funds, right? So from your super balance. Okay, as you can see here, the super contribution for application 1 and application 2 together is $27,600. So as you can see, your yearly cash outlay is just under 23, and your super contribution is $27,600. So your excess remainder is $4,611.82. And that means, break that down to monthly, is $384.32. So what can you do with this $384.32? So normally what we like to tell our clients is contribute extra into your loan so you can pay it down a lot more faster. And let me show you how much faster you can pay down this 30-year loan term if you contribute that extra amount into your loan every month. Alrighty guys, so if you go onto my website, you'll see calculators up here, and you can go down to the extra repayment calculator. Okay, so let's just break it down right now, right? So the loan's just call it $480,000, and the rate is at 7.74% over 30 years, monthly repayments, and we want to start paying extra from day one. Okay, and the extra I can contribute is $384.32. All right, so let's see here. So instead of a 30-year loan term, okay, you can actually pay it down by within around 22 years. So guess what? If you contribute an extra $384 every month, you can actually save yourself around 8.5 years on your loan term, right? So obviously, if the rates go down, if you contribute extra into your super because you got a pay rise, that will actually shorten a little bit more, right? So let's say, for example, the rates go back down to 7%, okay? You can actually pay it down a little bit more faster, right? So everybody, there you have it. That's just a quick example of what we'll be doing for some of our SMSF clients, right? So break it down, show them the cash flow, and also show them how fast they can pay down the loan by if they contribute an extra into the SMSF loan and how fast they can pay it down by. So everyone, I hope you enjoyed that little case study, and it's actually a very good case study because a lot of the examples that we've been doing the past 12 months actually fits within that range, the salary, the super balance, and how fast they can pay down that loan by, right? Some people, they can actually get a bigger loan, but they don't want to because they can't pay it off within that retirement time frame they wanted. So as always guys, hope you like this video. Please give it a like, this channel follow, please comment. I'd like to hear what you think about the video. As always, see you next time, and thanks for joining me on another episode of the Mortgage Chat. Peace.